One.
Welcome to today, May 18th, 2023's webinar from Bob Benny Wealth Management. I'm Bob Benny.
I'm Jesse Thompson.
And we're glad you're here. Today's topic is, we're calling this the May Market Checkup. Sometimes it's hard to know how the media reports things with what's really going on in the economy and in the markets. And this is going to be our analysis of the economy and markets and where things are at. And we hope it's going to be interesting, valuable, and encouraging to you.
Yep, and we're going to use some actual facts and numbers for you, some statistics to show you where things are at. And then we'll also give you some tips and strategies on what you can do considering where things are at with the economy right now. So we just want to reiterate that a lot of financial companies and maybe advisors will do things like market forecasts and kind of make predictions about how things are going to go with the stock market and with the economy and things like that. We're not doing that, and we're not going to try to do that. Nobody can accurately predict what the economy or what the stock market is going to do with any kind of consistent accuracy.
On a real short-term basis.
On a short-term basis, yeah. So it's kind of funny how in Nebraska, we complain a lot about the weather, right? We talk about how if you don't like the weather now, wait 5 minutes, that kind of thing. And we complain about how it's possible that a weather forecaster could get paid to do a job that they're wrong at so much of the time, because it seems like they are. But did you know there's a funny fact that weather forecasters are actually better at their jobs than you would think? And did you know that weather forecasters can actually predict 5-day weather forecasts, short-term weather forecasts with 90% accuracy statistically? And when we compare that with market analysts, they only predict short-term market changes, short-term things that happen in the stock market, what's going to go up, what's going to go down, what's going to do well, what's not, with 40% accuracy. So they're wrong more than half the time. And a lot of times these are the articles that you'll see on things like big stock market websites like Market Watch or
Yahoo Finance,
CNBC, things like that. And they'll say so-and-so from JP Morgan or so-and-so from name whatever big financial institution that you want. They're a market analyst that's paid by that institution to make predictions. And they're paid a lot of money and they're professionals, and they are still wrong on average 47. Well, they're only right on average 47% of the time. And
that's the actual professional market analysts. The financial news media people are even worse. They really don't know their heads from a hole in the ground. They all have journalism degrees, and that's all they know. They know how to keep your attention and keep you watching or reading their website. The one I'm thinking of is this guy on CNBC called Jim Cramer. And he is so bad at predicting stocks and things like that, that there's actually a strategy to do the opposite of what Jim Cramer recommends, and you make money, a lot of money. In fact, in these last 3 big banks failures that happened this year in the last couple of months, he was recommending to people within the previous 2 to 3 weeks of when these banks failed and were taken over by the FDIC, that he was recommending that people to buy them. And he's a clown, and he really is. He's entertaining because he's really energetic and things like that, but he does not know anything about, he knows how to talk and he knows how to keep people's attention. And that's what most of the media, particularly the financial news media, does, is their job is to keep your attention so you keep watching the ads, not to give you good financial advice.
Yep. And when you compare it of how big of a deal it is with like a weather forecaster, it's not that big of a deal if you go outside for most people if it's raining instead of being sunny outside. But it's a pretty big deal if you make a financial decision
Like
or are
panic.
influenced by one of these market analysts or by an article or something that you read to make a bad financial decision based on something that they said when they're wrong most of the
Right.
time. That's a pretty big deal. So we want to kind of caution you against that. If anybody says that they think this is going to happen, or a lot of the headlines that I see a lot of the times, or that people will mention is, well, I read that so-and-so from this company said that the stock market was going to go down another 20% before the end of 2023, or that there's going to be a recession by this time, or something like that. Whenever you see something like that, turn on your caution in your brain.
So we're not going to do that. We're going to look at the actual facts and tell you kind of what's going on with the economy and what you can do about it.
Yeah. So where do we stand? Is that our next thing? Yeah,
Mhm.
where do we stand? Current issues. A couple of current issues are interest rates are still rising. The Fed started raising interest rates about almost a year and a half ago. Went from 0 to 5.25%. Everybody knows that. They are going to keep going up. I guess that's a forecast for me. And the reason they're going to keep going up is inflation, which is the greatest financial threat to all of us, all Americans, and frankly, everybody all over the world. This super duper high double-digit inflation that we're experiencing and facing for a while, it's inevitable because of all the money that the government pumped into the just created out of thin air. They added 37% to the M2 money supply in a matter of 2.5, 3 years. The high rising prices of goods and services, what I'm calling hyperinflation. It's not technically hyperinflation, but it's double-digit inflation, is going to go on for a while. And the only solution that the government really has is to raise interest rates. And we've seen this happen before in the late 70s and 80s with high inflation and what they did. And it's just going to keep going up until they're able to get inflation down to their target rate, which is 2%.
And they came out with the inflation rate for April. And they reported it as 4.9% for April, which is less than what we've seen lately, but it's a little bit tricky. And if you've gone out and bought anything, you know that inflation is not just at 4.9%. And I'm not going to go into it in too much detail on here, but you can look up that the Fed, or I think it's the Department of, I can't remember which government entity it is, changed the way that they're reporting inflation now, starting in January of 2023, and it's actually on their website. And so you can look that up, give that a Google, and you can see that basically what they're doing is they changed it so that the numbers that are reported for inflation don't look as threatening or as big as they actually are, or would be if they had continued to use the same reporting method that they've used for years prior to this.
Are you saying that perhaps the government is lying to our viewers and all the rest of us? That's a shock. Well, of course they're lying. You don't trust the media and don't trust the government. That's kind of one of my mottos, personally. And then you have the news media issues. One of the big things that's been in the news media is these bank failures, and they love to scare people about the bank failures. And there was 3 big banks, starting with Silicon Valley Bank in California, that failed. And they failed because they were stupid. The people managing the banks literally didn't know what they were doing. They were hired because of their political affiliations and because of their wokeness, and ended up we've talked about this on webinars before. What they ended up doing is investing the bank's excess deposits. Excess deposits are deposits that are more than the bank's loaning out, because that's what banks do. They take your money that you put in the bank and they loan it out to somebody else. if they have deposits that are exceeding the amount of money that they need to loan out, they're allowed to invest in certain kinds of investments, certain categories of investments. And these banks, what they did was they invested their money, the excess deposits, in long-term treasury bonds. Super stupid, because interest rates were at historical lows, bound to go up. And when they did go up, the market values of the treasury bonds went down a lot, like over 10%. And so when depositors got scared, and through social media, these rich woke depositors, that's what they were, doing business with the bank because it was woke. I mean, to the tune of way more than the $250,000 FDIC limit, they started panicking, and within a matter of hours, billions of dollars were run on these banks, and they had to sell the treasury bonds at significant losses, and that caused the bank failures. So these banks were making the same kind of mistakes that we advise clients not to make, which is to invest in long-term bonds when interest rates are rising.
Mhm.
And
That's a very basic.
yeah, it's
financial
basic,
concept.
and it's just stupid anyway for them to invest excess deposits, deposits that are liquid any business day. Somebody can come and get their money out of the bank. Why would you invest that money in anything other than a very short term? And so that's what caused the problem. So.
Yep, so these are specific problems to specific banks. These are not problems that your bank is likely to have, or a bunch of banks across America are likely to have. And notice that when these banks failed, there was another bank willing and ready to come in and swoop them up, take over their business, no problem. So the banks aren't unhealthy.
But
overall.
One thing I will say is that if your bank or the investment firm that you do business with appears to be focusing on political issues, or think this woke political, in environmental, social government stuff, or the racial stuff, focusing on things other than taking care of your money, watch out, because they're not sticking to their knitting. And it's the same thing with companies. We've found that companies, individual, I'm not talking about banks right now, or investment firms, but individual companies that take their eye off the ball, like Anheuser-Busch, instead of focusing on making beer and marketing it and selling it to the people that like to drink Bud Light, they start, trying to get transgender people to like them. And we saw what happened with them. That Bud Light it may no longer be around in a few years. I don't know. It could be, because you got to focus on, when you're in business, you got to focus on making money, not on doing these other social issues.
All right, so the next news media issue that's gotten a lot of headlines recently is the debt ceiling deadline. And this is something that gets a lot of headlines every so often, and has for years. And it's always a big crisis every time it happens. And oh my gosh, what will happen if we default on our debt? Everything's going to go to hell in a handbasket, blah, blah, blah. That's not going to happen. What's happening and why it's taking so long is basically the politicians are using this as a bargaining chip to get what they want. Both sides are trying to get what they want and using the threat of this debt default basically as the bargaining chip to do that. If we actually defaulted on our debt, that would be like political suicide for all of those politicians. They're not going to let it happen. They also want to get paid. So
yeah,
it's not a nothing burger of a situation, because obviously the amount of debt that the United States has is serious and is an issue, but no, we're not going to default on it. That catastrophe is not going to happen. That's just news coverage of that is just basically fear mongering and to get attention.
Yeah, and that's what they've been selling, is a lot of fear. The news, the mainstream media and the financial media are focusing on fear and fear mongering in order to get people to read their articles, watch their shows, listen to them on the radio, et cetera, et cetera. Well, most of it, the vast majority of it, is wrong. And so you just got to take that with a grain of salt and don't listen to them.
Yep. And the previous issues that we talked about, the interest rate thing and the inflation thing, those are real issues that are affecting everybody in America. These issues that have been talked about a bunch in the news media recently and that have been causing a little bit of volatility in the stock market because of all the coverage of them has made people feel a little bit uncertain about how things are going and could this happen to me, that type of thing. These are not issues that are affecting every single person. These are issues that we think are being blown out of proportion.
So the good news we have to report is on the stock market. The first quarter S&P 500, that's the 500 largest stocks or largest companies on the New York Stock Exchange. Most of them have been reported for the first quarter of 2023 and mostly beat analysts' expectations and beat them a lot.
Yeah, so as of, it would have been Friday because the reports I have on these are weekly. So as of last Friday, about 92% of the companies on the S&P 500 had reported their earnings so far, and almost 80% of those companies that had reported earnings above expectations. And on average, they were 6.5% above what was expected, which is a lot. Both of those numbers, the 80% of companies reporting that they did better than expected, and that amount of that it was higher than what was expected, that 6.5%, both of those are better than the averages for the last 5 and 10 years. So that's good news. And right now, overall, the earnings that have been reported on the S&P 500 came in actually at a little bit less, almost a 0.5% decline for the quarter from this time last year. And by the time the rest of these companies report their earnings, maybe even by the end of this week, that could possibly go positive, because we've had some companies come out. Even Walmart came out today and had really good earnings. And so that could change by the end of this week. Analysts had actually estimated that there would be a decline this quarter of 6 or 7%. So what ended up coming out was way better than what was expected. One factor that caused earnings to not be more positive than they ended up being was companies who do a lot of business outside of the United States. And one way that we advise people that they can reduce the risk in their investment portfolio or their stock market portfolio right now is by investing in only US companies. And the reason for that is that companies outside of the US usually carry a lot more risk. They're a lot more volatile because capitalism is not thriving in the rest of the world right now, like it is in the US. Right. And it was interesting what came out with these earnings reports, because companies who do most of their business, more than half their business in the United States, they actually had an earnings growth rate of about 3%. And companies who do most of their business outside of the United States that are on the S&P 500 had an earnings decline of 10%, which is big. So,
and the overall revenue, so remember, revenue is your total money coming into the company, but then you have costs. You got to take the costs off, and that's your profit. Profit's what's most important. But the overall revenue for these S&P 500 companies is up 4%. The biggest sector of the economy that, or of these companies that did the best was consumer discretionary. And so that's positive. They had the highest earnings growth rate, and people are still spending money. I mean, what's my favorite store, Jesse?
Scheels. Everyone probably knows that.
Yeah, everybody probably. My favorite store in the whole world is Scheels here in Lincoln. They're not paying me to say that. I just love Scheels, but Scheels is packed all the time. It seems like it. You know, you go on the weekend and Scheels, you can't hardly find a parking place, and people are in there. They're happy. They have great service. They're working hard. The people that work there work hard, and that's what what's going on all over the country. You know, the places I've traveled, companies that are sticking to their knitting and focusing on serving customers and not woke stuff and not ESG and not different kind of political issues, those companies are thriving and are making money.
So the one other positive thing that we had to share about our economy was that the unemployment rate is at 3.4% right now. That's actually the lowest it's been since right before COVID hit. And the 3.4% is actually some of the lowest numbers that we've seen overall over the last 50 years. They're like record low numbers. So that's another positive indicator that our economy is still doing well. So what should you do based on that information that we've just gone over? So the first thing that you should do is focus on what you can control. These little short-term things that might affect the stock market in the short term, like we talked about, like the debt ceiling thing and banks things and things like that. We can't control what the stock market does. But what you can control is limit your news media consumption. And remember that these news stories are for clicks. I actually took screenshots of several news stories just this morning from different websites and a couple on the same website that were literally within minutes of each other. The Yahoo Finance ones were within minutes of each other. There's like a positive one down here, and then there's a negative one up here on the exact same. Basically, what they're looking at is just what the market is doing and changing their narrative second by second based on that. And then different websites are going to have different narratives as well. And those narratives can change minute to minute. These ones are about the debt ceiling, and this one is stock market rises because of the debt ceiling. And this one is, oh boy, we reached the debt ceiling.
It's a doomsday. Oh my God.
Everything is going to go to hell in a handbasket. And so, limit news and media consumption, especially when it comes to financial news.
And don't let the media tell you what to do with your money. Don't let the media affect your
Financial decisions.
Your financial decisions or your well-being, because they're purposefully trying to scare you to get you to keep watching, listening, reading, whatever it is. And if you have a tendency to catastrophize, if that's
he thinks I made that word up, but it's a real word.
It's a real word. All right.
Yeah.
If you have a tendency to catastrophize, just think it through all the way. The entire stock market, where most of you, our clients anyway, have most of their money invested, it's built on our economic system of capitalism and the free enterprise system. And the only way that it's going to completely crash is if those systems are done away in our country. And I know we all see the threat of socialism and communism, but don't worry. I'm pretty sure it's not going to happen. I'm pretty sure that capitalism is going to continue and freedom is going to continue in the United States. And you know what? If it doesn't continue, there's no safe place for your money anyway. There literally isn't. Your money's going to be worthless, would be worthless if our economic system crashed. Even gold, because there's a lot of people selling gold and running TV ads and commercials about gold, and that's how your hedge is or whatever is gold. What are you going to do with gold?
If the economy
the economy crashes, you're going to have gold and you're going to
shave off little
pieces of it to go to the grocery. No, it's going to be a barter system, which you need to have if you really think everything's going to go to hell in a handbasket, is guns, ammo, and food
and land
and land. And if you don't have the guns and the ammo, somebody's going to find out you got gold or food and come take it. So it could be crazy town if you think this clear through. Our advice to people is trust God, don't panic. Everything's going to be all right. These companies are making money. People are still going out and buying things, and everything's going to be okay, more than okay.
Yeah, and if you focus on or start thinking through different like what if scenarios, you can come up with an infinite amount of scenarios that you can't possibly prepare for. And just remember that the stock market has always grown over time. There's never been a time where it's entered into volatility that it hasn't recovered from and then gone on to grow from before in its entire history. And it's the best chance you have at protecting your money and your retirement against inflation, which that's not like a what if scenario or a what if threat. That's something that's here, and that's an inevitable part of life and an inevitable part of retirement that you actually can do something about. So moving on to the next thing that you can do, should do.
You want to make sure that your investments are allocated in the best types of things to protect yourself from this super high inflation and rising interest rates. So these are three categories of investments that you should not have money in, or shouldn't have too much money in, that's for sure. You shouldn't have too much money in cash. I'm calling cash, actual cash, in your purse, wallet, or safe, savings account, checkings account, money market accounts. You should just have a few months of cash in the bank or wherever in order to, a few months of living expenses in cash, I mean, for kind of an emergency type of fund. Because the problem with cash is you lose buying power. If you have $100,000 in cash right now and checking savings at the bank, you can buy $100,000 worth of stuff with it right now today. But if there's 10% inflation, and there will be, in a year, you'll be able to buy $90,000 worth of stuff, and the next year, $80,000. So you don't want to have too much money in cash. You lose buying power. It's a very similar thing with CDs. Lose buying power with CDs, although they pay a little bit higher interest rate, but the interest rate that the CDs pay at the banks is still substantially less, and historically will be and has been substantially less than what the inflation rate is. Very similar thing with bonds, even though bonds pay a little bit higher interest rate, but it's even worse of a problem with bonds, because bonds, the way bonds work, you can sell a bond, even if it's a 10 or 20 or 30-year bond, you can sell that bond any business day for its fair market value. However, the fair market value of bonds fluctuates opposite of interest rates. So when interest rates go up, market values of bonds go down. And so you want to stay away from cash, CDs, and bonds during high inflationary periods. And the way to protect yourself, protect your buying power, is with these three categories of investments. Companies is the best. Income producing real estate is a distant second. And finally, gold. I don't like gold as much as companies, because it doesn't produce a good or a service like a company does that it's selling for a profit. It doesn't produce any rent. The best, in my opinion, and my experience, our experience of me doing this for 27 years and Jesse doing this for several years, our experience and our research has shown that companies are the best hedge against inflation. First, logically, because companies produce the goods and services whose prices are rising. So that makes sense, doesn't it? But also, historically, when we had this happen before, and history repeats itself, when we had this high inflation like we're having now and gonna have in the late 70s and early 80s, the stock market beat inflation big time. It not only held your buying power, but it beat inflation during that time period. And so if you want to see the evidence, the proof of that, give us a call and we can show it to you, or you can come in and we can visit with you about it. Second best, distant second best, is income producing real estate. Over time, the value of the real estate goes up and the rent goes up. And finally, gold. And I kind of downplayed gold, but gold is still a better investment than leaving your money in the bank.
All right. And lastly, the third thing that you should do is stay invested. And I've done we've mentioned this tons of times, I feel like, in webinars and in articles that we've written on our website and things like that, because it's so important. And I think it's such a huge temptation for investors to try to time the market. And by time the market, I mean, they try to get out and avoid being in the market when it's going down, and get into the market while it's going up, so that they're only in for the good times and they miss the bad times. Well, like we talked about before, nobody can forecast what's going to happen in the market in the short term accurately and consistently. And so nobody can do that efficiently. And second off, it never turns out well. And this is a different study than the ones that I've shown in the past, but it just reiterates the exact same thing, that you're better off staying invested through the ups and downs of the market than trying to play it and get in and out to miss out on
what happens, if I can interject for a second, Jesse, what happens with people that try to time the market is the market starts going down and they think, oh, it's going to go down a bunch more and I'm going to get out. And then their plan is they're going to get out, sell here. And when the market goes down and reaches its bottom, they're going to buy and they're going to take advantage of the rise back up. But my experience and research has shown that what people almost inevitably do that try to time the market is they get out here. And by the time they're comfortable enough to get back in the market, it's gone down, gone back up to where they got out, and then it's risen more, and they'd have been better off if they just stayed in the market. So go ahead. So
this chart proves that. So this is a hypothetical growth of $10,000 just invested in the S&P 500 index starting in 1980. So that's a pretty long time frame and it goes to the middle of 2022. And so someone who had been invested and just stayed invested and wrote out all the things that happened between 1980 and now. And you can think right off the top of my head, there was 3 big market crashes. There's one in the 80s. There was the dot-com bubble in the early 2000s. And then there was 2007 through 2008, right? And that's a time when a lot of people freaked out and wanted to get out of the market. But this person just stayed invested through that entire time. And their $10,000 would have turned into $1,060.
No, $1,060,000. $1 million.
Sorry.
But 10,000 growing $1 million is a big deal.
Yeah, that's a really big deal. Okay, so if they would have only missed 5 days,
the 5 best days,
42-year period, the 5 best days, their return that they would have ended up with would only be $655,981. Now, 5 days doesn't seem like a lot. And what's tricky is that the best days in the market often live right next door to the very worst days of the market. So you can have one of the worst days in the market, and literally the next day could be one of the best days in like 20 years in the market. They often are right next to each other because there's a lot of volatility during those times. And so if you are out of the market at that time where you hit one of the 5 best days of that entire time period, it makes a huge difference on your return. And the more good days that these people miss in the market, the more their return goes down. So it makes a huge difference to just be patient, stay invested, know that the market trends up over time. And the longer that you stay invested, the better chance you have at getting a good return. So there's always going to be volatility in the stock market, but some ways that you can mitigate the amount that you're exposed to are by doing the following things. 1, investing in large companies. Large, well-established companies with good fundamentals, for example, like the companies on the S&P 500.
You're going to have a little bit less risk with the larger companies than with the smaller companies. A lot of times the smaller companies are a little bit newer, that kind of thing. Secondly, stay invested in U.S. companies like what we talked about. Capitalism is doing well in the US and it's not doing that well in the rest of the world. And so right now you can reduce some of your risk by staying invested in only US companies. And lastly, make sure that you're properly diversified across many different companies. And so
you can actually fully diversify an investment portfolio by being invested in only 10 to 13 companies or 10 to 13 stocks if you choose the stocks correctly and they're different enough from each other. But if you're invested in a fund, like an index fund, which is what we use, they're called exchange traded funds, ETFs, you're automatically invested in a basket of companies that's usually well over 100 companies. So you have a lot of built-in diversification there.
The portfolios that we have discretion over that are invested in index type ETFs, our clients have their money spread out across several hundred different companies. So they don't have to worry about one company doing something stupid or just having bad luck and going bad. It's not going to kill them. So there's some, if you're extremely risk averse, there are some options for you. One is to insure your portfolio, or in other words, insurance companies provide investment vehicles that, for a fee, they can protect your income, they can protect your death benefit, they can protect you from loss of principal. But they're, number one, they're going to charge you a fee for this. And over time, well, it ain't going to be a matter of over time. You know, if the fee is 1 or 2% for whatever kind of guarantees that you want, you're, you know, over a 20-year period, you're going to make a lot less money than if you just left yourself, but you're going to have the peace of mind. So if you need peace of mind, you can insure yourself peace of mind by paying an insurance company to protect you. And we can explain that. If you have questions about that, please contact us. We can explain the ins and outs and the pros and cons of insurance. But it's generally like any other kind of insurance. You know, homeowners insurance. Most all of us have homeowners insurance, even if our house is paid off. And you know, and we pay it like clockwork because we don't want to suffer the catastrophic loss of a fire or a tornado. But if we hadn't had that homeowners insurance and we didn't have a fire or tornado, and at the end of our life, we would have more money because we weren't paying that homeowners insurance. It's the same kind of concept. So, and then another thing is that a very small number of people, of our clients, are doing, if they want to make a little bit of more money than what the banks are offering, they can buy an extremely safe short-term treasury bill, 3 months or 6 months, that are paying in the range of over 5% on an annualized basis. If you just want to stay out of the market for a little bit of while, that way you can make more money than you can on your cash or CDs.
Yep. Okay, so that wraps things up for where we stand and what you should do. Just to review, what you should do is 1, focus on what you can control. Number 2 is make sure that your investments are allocated efficiently for our economy right now. And the last thing is to stay invested. So we're going to go over any questions we have right now. Doesn't look like we have any. If you think of any, you can always email either of us, bob@bobbenny.com or jesse@bobbenny.com.
And we're here to help. Our goal is to help people in whatever way we can by answering any kind of financial questions, whether it has to be with a home purchase or a mortgage or a car loan or retirement income planning or estate planning, how to protect your wealth for your heirs, all that sort of stuff. And if we don't immediately have the answer for it, we'll find it out. We'll research it to help you. We don't charge for consultations or anything like that. We just want to help. So if you or your family members or friends have a financial question that you'd like to run by us, please contact us. Another thing we also welcome anytime for anybody that watches these webinars is for you to give us some feedback. If you'd like us to do something different, or if you have some ideas on future webinars, please let us know. We'll take it into consideration. And I guess that's the end. And we just hope you all have a blessed day. Thank you
very much.